Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, February February 10th at 7:45 a.m. and the market is not having a freak out over um, a Trump policy this morning or DeepSeek or one of the other things. So we're starting out on the calm side. Note that we're recording this a little bit differently. We're using the Substack app. We received a few comments about the quality of the audio. So rather than recording on Zoom and making a file and loading it to Substack, we decided to record right on Substack. You don't get the cool chart behind me. I haven't figured out whether I can do that or not yet, but hopefully the quality of the sound's a little better. So our note this week was titled Targeting Tens. That's a reference to both the president and Treasury Secretary stating that they're not worried about the Fed policy rate as much as they're worried about the 10-year Treasury rate. This is because we have a hedge fund manager as Treasury Secretary, first time that's ever happened, and someone that actually really understands markets. Not that Treasury Secretary Mnuchin didn't, but Bessent, we think, has got lots of interesting ideas. So the note was broken into four sections. We had the first section titled "Looking for Vol in All the Wrong Places." This was us making our argument that of the evil twin deficits, the much bigger evil is our budget deficit, not the trade deficits. And we went on to describe, the first chart shows just how much pressure Chinese corporates are under. They have negative earnings growth, negative revenue growth, and falling profit margins. And we think they will need to absorb tariffs into those margins because they've got nowhere else to go. Sure, they're not exporting as much directly to the U.S. They're sending steel to Canada. Then it comes to the U.S., not fooling anyone. Treasury or Council of Economic Advisors, Hassett was on TV talking about the reciprocity line, something we've written about, essentially how much higher tariffs are for our products being shipped to our major trading partners than we charge in Asia in particular. There's been lots of details about that over the course of the weekend. And so just count on trade policy tightening. But again, the real risk is our own deficit. And so that's what the second section of the note was about, the centrality of spending. We went through it administration by administration just to show what happens to debt when you start running spending over 20% of GDP. And on the path we're on right now with spending between 24 and 25% of GDP for the next 10 years, debt is going to rise to 154% of GDP, according to the SIBO, over the next 20 years or so. So major problems. And as a consequence, we remain short duration, even though we do think that this economic team has all the right ideas. And we do think Congress will have some success in cutting spending, but they need to prove it to us. And so in the meantime, we remain short duration. We then went on to a detailed discussion about the employment report, which was an absolute mess. A year ago, they decided that the population had shrank by 625,000 people, which was nonsensical at the time. We knew we were having a flood of immigration. This year, they decided, oh, yeah, we found 2.9 million people. It made an absolute mess of the report, but there are a couple of important takeaways. One is the number of unemployed went up by 1 million people in the latest month. So if that number holds, that implies that the VU ratio, that's vacancies or openings to unemployment, that ratio has fallen to 1, a level that we think will get Chair Powell and Governor Waller's attention, the Fed leadership, so to speak. We're not convinced by the report that the foundation of the labor market really isn't weak. Small business employment is indeed weak. They've had a bounce in business confidence. We're going to get the latest number tomorrow morning from the NFIB about small business confidence, but we still think the foundation is weak. And in particular, churn or labor market turnover has absolutely collapsed. That bodes very poorly for productivity growth and real wage growth over time. So it's a real point of contention, not to mention the fact that government employment growth and wage growth is running much hotter than the private sector. Again, not good for productivity over time. The one big note in this week's report was our upgrade of financials. We're now marginally overweight financials. We took it out of tech. We still have a very heavy weighting in tech, although it's a marginal underweight. But to get all the details, become a full paid subscriber. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.